Welcome to the Explainer. So, Scotiabank just put out its Q4 2025 earnings, and wow, the market went wild, sending the stock to an all-time high. So, what on earth was in that report? Let's get into it. We're going to break down the numbers, the strategy, and what this all means for you. Right off the bat, you can see the market's reaction. Scotiabank's US-listed shares shot up almost 3% right after the announcement. And back home in Canada, the stock just rocketed to a brand new all-time high. That's not just a good day. That is a massive thumbs up from investors. So what got everyone so excited? Well, in the world of earnings, sometimes you meet expectations, sometimes you beat them, and then sometimes you just blow them out of the water. Scotiabank did the third one. They absolutely sailed past what Wall Street was expecting. Just look at these numbers. The adjusted earnings per share came in at $93. That's a full 9 cents higher than the consensus. And revenue? Even better. They brought in $9.8 billion, which smashed the estimates by almost $400 million. That's what you call a clean sweep, plain and simple. But here's the thing. Results like this don't just happen by magic. They're the payoff from a huge strategic shift. A pivot, really, that the bank has been working on super carefully for the last 2 years. The CEO, Scott Thomson, said it perfectly on the call. He said this was a year of execution. And the plan was pretty clear. Double down on their main North American business, move capital to where it makes the most sense, and really focus on those high-margin businesses that bring in fees. And well, based on these results, it looks like that plan is absolutely firing on all cylinders. And you can see the proof right here. Return on equity, which is a key way to measure how profitable a bank is, jumped way up to 12.5%. Their efficiency ratio got better, which basically means they're spending less money to make more money. We're seeing different parts of the bank working together better. Referrals are up 18%. And through it all, their capital position is just rock solid. These are pretty much all the green flags you want to see. So you might be asking, where did all this growth actually come from? Well, the real powerhouse this quarter was their Global Banking and Markets division. Net income there just exploded, up 50% from last year. And when you throw in a really strong 17% growth from their wealth management business, well, that's the 1-2 punch that really powered this whole quarter. All right, so after a great quarter like that, what's next? Looking ahead to fiscal 2026, management sounded pretty optimistic, but they were also, refreshingly honest about some of the risks that could be on the horizon. And this really sets up that classic debate between the bulls and the bears, right? The bull case is all about management's guidance. They're aiming for double-digit earnings growth and want to push that ROE up towards 14%. The bears, on the other hand, they're looking at things like rising credit costs and just general economic uncertainty. And that tension right there is really what's going to define where the stock goes from here. During the Q&A with analysts, everyone seemed to want to talk about one thing: the bank's $31 billion exposure to private credit. It's a bit of a hot topic right now, but management didn't shy away. They defended it, saying the portfolio is high quality, that they were conservative in how they underwrote it, and that they're mostly in the safest parts of that market. Okay, so to really get why this quarter was such a big deal, we got to take a step back and look at the bigger picture. Because this wasn't just a great performance in a vacuum. Scotiabank pulled this off when expectations were already through the roof. The stock had already been on a tear, you see. It was handily beating the broader Canadian market over the past year. What that means is the bank wasn't just reporting numbers. They had to defend a high valuation, where everyone was already expecting them to do great. The pressure was on. And that was the real challenge here. It wasn't enough to just do well. The entire Canadian banking sector was trading at these really high valuations, about 23% above their 10-year average. So the bar for success was set incredibly high. And what did Scotiabank do? They cleared it with room to spare. So, after all that, what does this mean going forward? What's the call on Scotiabank from here? Let's get right into our thesis. We've seen the great numbers, we've seen that their big strategy shift is working, and we've heard the confident outlook. So what's our call on the stock? We're rating it outperform. And here's why. That big strategic pivot, it's not just a plan on a slide deck anymore. It's a real profit-making engine. The momentum they have in their best businesses, like capital markets and wealth, looks like it can keep going. Management's guidance gives us a really clear roadmap for growth. And yeah, there are credit risks, but they seem to have a good handle on them. We just think that this combination of great execution and real momentum has the power to keep driving this stock higher. And that wraps up our breakdown of Scotiabank's really impressive quarter. It's a great story of a strategy that was executed beautifully. This is not financial advice.